Welcome to the Restaurant Boiler Room, Season 2, Episode 13. I'm your host, Rick Ormsby, Managing Director at Unbridled Capital. Today in the Boiler Room, with the elections mostly behind us, we will be discussing possible tax and legislative changes that could affect franchisees in the operation, financing, and sale of their businesses in 2021 and beyond. I've invited two tax experts to share their expertise with us, Dan Clift and Jim Ball. These guys are excellent. It should be a very informative session for everyone. The Restaurant Boiler Room is a one-stop shop for multi-million-dollar merger and acquisition activity and financial complexities affecting the franchise restaurant industry. We talk money, deals, valuations, and risk, delivered to the front door of franchisees, private equity firms, family offices, large investors, and franchisors on a monthly basis. Feel free to find our content at Unbridled Capital's website at www.unbridledcapital.com. Now, let's enter the boiler room. Welcome, everybody, to what we're calling the tax and legislative changes affecting the franchise valuations. I mean, this is a topic that is getting a lot of attention right now. And so before I introduce our tax experts and good friends of mine, I'll say this, it was after, I'm not a very political person, but I'll say it was just after the election was made to Biden, that Saturday, whatever that Saturday was. And on Monday, I got, I think, almost a dozen calls from large franchisees, saying, what is this going to mean to the sale of my company? And at that point in time, I kind of realized, this is a topic that affects a lot of us because especially in a big life-changing event like the sale or financing or the acquisition of a company, I mean, you are at a kind of a milestone event at recognizing, a big tax event. And you're obviously, if you're a franchisee looking to sell your company, you're clearly as interested or more interested in the net number than you are the gross number, right? So this is one that hopefully you'll find applicable. Again, these are just going to be opinions, but hopefully they're good opinions and you can use them or follow up with this anytime afterwards. You know me, I'm the ugly guy over there on the left as you're looking at the screen. I wanted to just quickly introduce Dan Clift and Jim Ball. Dan is a managing partner at William Wetterer & Company. He's just an excellent guy, very, very smart guy. He's a managing partner there. He's a great CPA, gives a lot of good advice as it pertains to high net worth individuals and businesses. And he's got a good perspective on tax that I think will be really valuable for you to listen to. And he's located, as Jim Ball is, in Louisville, Kentucky. Now, Jim Ball, interestingly enough, is Derek Ball's dad. And Derek works for Unbridled Capital, as you know. Jim started off at the IRS, so we didn't like him. Ha, ha, ha. Now we do. He's been an attorney, got his law degree, and focuses, on estate planning, high net worth individuals, and has a great perspective on tax. The two of these guys together are like peas in a pod. So thanks again, guys, for joining us, and welcome to the webinar.
How much do we owe you for that introduction? Right?
Hey, man, I'm all about spreading the love. You know what I mean?
Yeah. Well, you also forgot to mention that Jim, in his former life, was also a CPA too. So. Oh, I knew that, actually. Yes, I'm sorry I didn't mention that. What else were you, Jim? Did you used to jump tall buildings with a single bound?
Well, I really can't talk about that in public, so leave that for another day.
How cool is it, as a side story, that, I can share this, I guess. Dan is my CPA. And as I was meeting Dan, he said, hey, Jim Ball is a friend of mine, and he's got this kid named Derek who, you should talk to about coming to work at Unbridled Capital. And that was about 4 years ago. And Derek's turned out to be, one of our key folks in the company to help it grow. So I don't know, man, it's a crazy little world we live in.
It is a crazy world.
It really is. Crazy world. Okay, so here we are, summary of discussion. I'm going to go through the first slide, spend a few minutes on it. And then after that, I think I'm going to turn it over mostly to these gentlemen so you can hear their expertise. They're going to talk about the shifting political landscape, some of the looming tax changes and what it might mean to you. I want them to talk a little bit about the PPP loan forgiveness and taxation program. And there's been some stuff come out today, guys, that I've been reading about a second round of PPP for people who have less than 300 employees. And, we experienced 1/4 of 30% sales drop, a revenue drop over last year, could apply for a second round of it. That's something we may chat about because I personally pops into my mind. Want to talk about estate planning. There's been a lot. I've been getting a lot of calls. I know you guys have been too, about the estate planning exemption maybe changing and what that does for franchisees and for business owners. And then I think we'll spend some time talking about flexibility and what to do as you think about what's going to happen or what could happen to our tax and legislative situation. And then we'll answer some questions along the way. Does that sound okay with you guys?
It works.
Awesome. Okay. Well, I am going to refer a little bit to my notes again. I was just jotting down today, like, where have we been in 2020? So humor me for a few minutes. January to March of 11th, before, which I can kind of consider the day that everything fell apart with the pandemic. We were in an environment where sales and profits for most brands were largely flattening. Margins were a little bit under pressure. You can remember that there was a big push by franchisors for development. And so over the storyline starting the year in 2020 was largely one of these of there's too many restaurants. Sales have flattened and headed downwards nationally across all of restaurants. And traffic was under siege because of overdevelopment and kind of a little bit of moderating consumer spending. So you started seeing like 5 or 6 of the national lenders in the franchise space kind of pull back. A couple of them stopped lending actively, shut down their franchise lending arms, and some others were quietly kind of ratcheting back their lending, kind of platforms. M&A prices were still strong. There was a pretty good equilibrium between buying and selling companies. And so prices on an EBITDA basis and cap rates were largely, kind of flat. I would express it as slightly beyond the crest of the wave, and margins for franchisees were a little bit under pressure, right? They're a little bit under pressure. So we jumped into March 11th. Unbridled had just received a Dealmaker of the Year award down in Dallas for the Franchise Times for selling a 100-unit Pizza Hut business. And then, as we were down there, wham, it all changed. And I know each of you who's listening here can think about the fear and the confusion and everything related to it. If you own a business and you stare at the ceiling at 3:00 in the morning, like I did, I think about it I know where I was in middle school when the spaceship blew up, right? Obviously I was at Vanderbilt MBA school preparing for a final exam, when the Twin Towers came down. I mean, I'll never forget where I was when, and I'm sure you won't either, when the COVID pandemic really hit. And we were all shocked, We come into May, the PPP program was pretty widespread. I'm not a big believer in government programs, but I'll tell you, I think it really did a lot of good in getting capital in the hands of these businesses and had it filter through to employees and the average public. And you started to see, quietly speaking, some franchisees and certain brands really start doing well. I know we eventually ended up selling it. It was like a 70-unit Sonic business, Buddy McLean's business in the Southeast, mostly in Florida and then up in Alabama too. And we started learning that the Sonic brand was one, and so was Wingstop, and so, anything that had delivery and drive-through, sales were all of a sudden up 20 and 30 and 40 and 50% year over year every day. And, we started seeing the resiliency of people wanting to eat out, but they weren't doing it in casual dining and largely not fast casual either. They were doing it in QSR. And so we started seeing that in the May time frame. You started seeing a big push to pizza and to chicken. Obviously, pizza is easy to understand why. Pizza was a concept, you can get it delivered, you can carry it out. It's easy to be contactless. But chicken was one that was a little surprising, maybe because though of the ability to order it for a family and the fact that it transports and it reheats well. The chicken QSR business really took off while burgers and tacos were lagging a little bit. You get into June, a lot of our deals had frozen, and we just took all of our clients and said, hey, let's pause. Let's stop. Let's increase due diligence periods. Let's stop the APA negotiations on our assignments for a couple of weeks, and we were just trying to create time and space to see what was happening. But in June, our deals started kind of coming back. And we thought at first that it was going to be one of these situations where you would have, the retrading happening, and a $20 million business we were selling would all of a sudden get retraded to $16 million, but it wasn't happening. And it was because sales and profits were up. And there were enough lenders that were stepping back into the space, seeing the strength of QSR, and the buyers saying that these businesses look like they're COVID proof, that led to prices staying strong and deals actually continuing to happen that were in process. And so we got into the kind of the July, August timeframe, and QSR sales continued to strengthen. We were, dining rooms were still largely closed, as many are today. And so profits were up even more than the flow through on a dollar increase in sales would justify. So you had this mushrooming effect on the bottom of the P&L. On the casual dining side, you started seeing bankruptcies. We started seeing clients generally ask the question, is it maybe time to sell? I was a little afraid coming out of this pandemic, but my business is up. I'm willing to take what I was willing to take before, maybe a little less. It's now the time to do this. And, and if there's anything you hear about the M&A market from me today, it's going to be all the impact of supply and demand is probably more powerful than just EBITDA or any other little driver, right? So at the time in July, August, and September, there weren't any deals on the market, right? So we had a couple, we put like 5 or 6 deals on the market. And when we did that, we had way more interest than I thought. And it was because there was plenty of demand. Maybe demand, there's, if there had been 10 buyers on the average deal, maybe that there's now 8. A couple of them went away, right? Some family offices and private equity firms were investing in airline industries and other places that were in trouble. And so they had to cover their losses and they didn't want to expand. But a lot of those folks wanted to come back into the restaurant business because of its stability on the QSR side. And you didn't have any businesses for sale. So we put these businesses on the market, and lo and behold, it had a lot of interest and prices were up. A lot of it, the multiples stayed about the same, but the actual EBITDA of these businesses really was increasing. And the marketplace was recognizing that the strength of the industry was leading to higher prices. And so a really smart move by some of these guys to jump out and get in front of it when the supply was low and the demand was still there. We now trail into November and December. Things are a little bit quiet. And this is where we find ourselves today. And I know I've been rambling, but I thought it would be a good time to give you the past year, right? As we go, woo, and we count our blessings for still being here, even amidst all the fear we felt in March. But we find ourselves here now in November and December. We're looking at a political change, right? We're going to have a new president. We're looking at still some continued craziness in Congress, and we don't know what the Senate will do. And we're going to opine today on what potential ranges of legislation and tax changes could be in play and how that might kind of not only impact the sale or financing of a company, but also, like I said earlier, impact the supply-demand curve of M&A in early 2021. That's all I've got, guys. Let me say that, but before I move on, the punchline is going to be this from me, and then I'll let these gentlemen speak. If your horizon to sell your company is within the next 5 years or less, say the next 2 or 3 or 4 years, I'm here to tell you that you do not do yourself any favor to wait any longer. And if your goal is to continue to build a perfect P&L until May of 2021 on a TTM or trailing 12-month basis, I'm here to tell you that when your deal goes into due diligence, unless you can lap last year's sales, you're going to be retraded. You're going to be retraded if you have significant sales declines during due diligence. It's going to be like catching a falling knife. So don't hold out for the best, for the very last dollar of EBITDA in your P&L. And in my mind, there's so much murkiness with tax increases and minimum wage increases on the horizon that you would be unwise, I think, to not heavily consider selling soon or now if you have a horizon that's small. If you have a longer horizon, then it doesn't matter. You'll see another upside and downside and a couple of valleys and peaks between now and then. And you should be consistent. You should be thinking today instead on legacy and estate planning, which we'll touch and talk about. Okay, here we go. Shifting political landscape. Gentlemen, I want you guys to just kind of weigh in, and now I'm going to talk a lot less. Go for it. Tell me what you think as you guys look at the tax and legislative changes.
Go on, Jim. You go first, brother.
Obviously, we don't know what's going to happen with the Senate. So all of this stuff that we'll be talking about today that we think could happen, certainly that Mr. Biden would like to have happen, you've got to take it all with a shaker of salt, because there's no way he's going to get everything that he wants. But we're going to lay out what it is that he's talked about over the last several years and more recently in terms of what he would like to see in terms of changes in the tax law. Whether he's going to get those things or not, because some of them are pretty darn drastic, and even some Democrats like Senator Manchin of West Virginia have indicated that they're not going to go along with some of the more drastic stuff. So he's going to have to, regardless of what happens with the Senate, he's going to have to pull in a couple of senators from the other side at least. But I think we have to assume that there's going to be some of these changes. Right now, we don't know what's going to happen in Georgia. A lot of this depends on what happens in Georgia. It looks like, even though there's still some little battles going on, it looks pretty much written on the wall that Mr. Biden is going to be the president on January 20th. So we know what his intentions are. We just don't know what he's going to be able to get through.
I would echo that too, Jim. I mean, I think the main thing that you have to be concerned about is being a little bit of flexible as you're going through this. You've got to know what the potential is. Taxes are probably at the lowest you're going to see in the next few years, right? So, they can't go any lower. I don't think that's going to happen. I think you go back and you think about what happened when Trump was elected and he was going to make all these drastic changes. And it took him a couple years to actually get that through. You've got the same thing that's going to happen for Biden. You've got, a lot of Democrats are going to be up on the midterm elections. What's going to happen to the Congress at that time? So folks are going to be a little bit more conservative than all out. So that's important. But as we're going through this, think about what makes sense. Don't let the tax tail wag the dog. Rick, your comment about getting calls after they called the election for Biden, I got the same call. I got a dozen of them, and hey, we need to close the transaction. I got $100 million transaction and a couple others going on, and they're like, "We're done. We're going to close it right now." And so that puts you, in a very quick maneuver, right? And sometimes it's hard to recover from that from a tax standpoint. But when you look at it, don't let the tax tail wag the dog, but be very tax mindful as you're going through these things. If you have a little bit of advice there that you can, spend your money wisely, it makes a lot of sense, and you get a little bit of, return on that.
Mm-hmm.
That's it. Absolutely. That's what I wanted you to show, Rick.
Yeah, I thought this was a pretty interesting thing. I mean, the election betting odds it's kind of a funny thing. That's way better than listening to the stupid news channels because they're so wrong. It's it's like, I mean, I don't know, but what do you think?
Yeah. I'm still impressed that Donald's got a 9.3% chance, right?
Yeah.
I mean, I don't know where that chance comes from, but the real important thing is what happens in the Senate, right? So if the Republicans can hold and pick up one seat, they sit at 51. Okay, so right now we're going into this 46 Democrats, 2 ultra Democrats, Bernie Sanders and Augustus King on the left, right? Just call them ultra Democrats. So you got 48 to 50. We got 2 seats up, right? So if the Republicans, and it looks like on the betting odds it's 71%. Interesting, last time we were looking at these things, they were changing as we were just talking, weren't they? So, yeah. So they'll move again, right? But kind of watching that, how many friends do you have that moved to Georgia to get in an election, right? So that throws that out as an important issue. But the concern was that Biden's going to automatically raise capital gains tax to 40%. Okay. Is that a reality? It may be, right? And we're looking at that, and he wants the means test that. It's when you have, over $1 million, right? So any transaction that we're talking about is going to be over $1 million, and it's going to be at that, potentially at that higher rate. Okay. But how quickly is that going to come? Right. So if you're looking at, and I think you're wise, if it's a 5-year time horizon, he probably gets tax reform done in 4 years, but I don't know that it's going to be tomorrow, but it's probably not going to be, 5 years from now. Right. So you've got to weigh that in your decision. And again, it's a tax tail wagging the dog, but if the tax tail goes double, that's a pretty big tail. Right.
Yeah. That's not a tail. That's like I don't know, man. What is that?
Extra like appendage, right?
Yeah, I mean that's like the torso or something. I don't know.
Right.
Yeah.
Kind of like a kangaroo tail, maybe.
Kangaroo tail.
Yeah, really well said. Anything? Let's ask this question because I hear this question a lot. I mean, what do you guys? I mean, no one has the final opinion on this, but a couple of things. What do you think the likelihood of tax increases is retroactively? Number one, and number two. We've had a couple of franchisees who are very well connected politically that say some of the Blue Dog Democrats are going to vote against tax increases, potentially, especially I keep hearing Joe Manchin in West Virginia. I keep hearing that name over and over again. So any comments on either of those two, because those things impact people's transactions. So everyone here is listening ears.
Well, we expected, media told us that it was going to be a blue tsunami, right? And, looking at the polls prior to the election, it was going to be a landslide, 10 or 15 percentage points. We didn't get that. Okay. So the appetite maybe wasn't, what they portrayed it to be. Okay. And I say they as the media. I'm against the media, not to pick a political side, but they kind of led us in a direction. Will it change? Will it be drastic? I don't know. But we were talking about conspiracy theories at that time. Right, we've talked about that. Were they going to read something into the law during this lame duck and then come back and make the taxes retroactive? I don't know that that's a high risk right now, but it really has a lot to do with what happens in January. On January 5th is really the tell. And if they hold the seat, then we can feel pretty good that they can't pass tax legislation without Senate approval. So that's a big holdout. Jim, I know you've got some more comments about, the specific senators and the West Virginia and whatnot. So your shot there.
Well, actually, I wanted to touch a little bit more specifically on tax changes being retroactive. In the past, and y'all probably seen this and wondered about it, you'd see some law that's effective July 23rd, 1984, and you're like, how in the world they come up with that date? Somebody must have known somebody. And they had a transaction that occurred on the 22nd, so they wanted it exempt from that tax. But in reality, generally, and it's just a fairness issue, really, it's unfair to make a tax change that's unfavorable to the taxpayer without them having notice. Because let's say you're selling a franchise or any other business deal, and you're doing it based on what you know the law to be. And then they changed the law back to the date before you made the deal. If you had notice of that, you might have done the deal differently or not done it at all. So it's always been the standard to not make a disadvantageous tax law retroactive to a date prior to some date when the public is deemed to have notice, for example, when it's first read in committee. And that goes to Dan's comment. Even during the lame duck session here, they could introduce a tax bill that they think could maybe be passed next year. And therefore, let's say they do that on December 15th, just to pick a day. They could maybe make it retroactive or make it effective on December 15th. But then they go a step farther and say, not a lot, but often enough, make it effective for that entire year. So there's a chance that they can make a law retroactive to cover anything in 2020. I don't think that would ever happen. There's too many of those middle of the road Democrats. You don't have a lot of middle of the road either party anymore, but there are several who would not permit that to happen. So I don't see anything being effective in 2020.
So that gives us a little bit of a window of opportunity potentially. But I like Dan's comments too. I don't like them, but I don't like them at all actually. But Dan's comments are that we're probably looking at a higher tax environment at some point. So there is a window of opportunity here, and maybe we'll go to the next slide and just chat about that, and let you guys just kind of opine about what is on the table, whether it's today, tomorrow, next week, or next year, and what are we talking about here? How conceptualize this for folks?
So the main thing that you're looking at is what are the rates? So the conversation that Biden's having, and it was a conversation that everybody was having. Is 20% corporate rate too low, right? He's thinking 27, 28%, and it's kind of flat. There's no graduated tax in his belief. Then you come back to the individual side of things, and you look at a rate increase for those over $1 million back to 39.6, which, we're just calling 40%. So what are the chances of that happening? I don't know if they move exactly back to those same things, but they probably change, and they don't change for the better. They change for the worse if you're a taxpayer. It depends on which side you're on, right? But a big important, issue is, there is a break point on some of this. Okay, top 5% of wage earners in the United States make over $150,000, and they pay 85% of the tax. So it's easy to pick on those guys. It's easy to pick on a franchise owner that's employing 100 and some employees, right? It's easy to pick on them because they're making all kinds of money, right? That's the problem, and that's the issue that's out there. And Bernie Sanders loves that issue, didn't he? He was beaten up, on that the whole time. So Biden shared some of that. It's when it's over $1 million, we're going to put that into play. That might play. There's some Democrats that don't subscribe to that. Some more moderate that we hope that stay on the correct side of the aisle and don't subscribe to that. But the chances of the taxes going up, I think, are pretty high. It's hard not to think that they won't go up in the near term. And the question is when, right? It's not the question of if, it's more of a question of when.
And some of the taxes you're talking about, corporate income taxes would be one that's definitely probably on the table, right? But that is less probably, not entirely inapplicable to the franchise community if we're speaking to a 30 or 50 unit franchisee. And Des Moines, Iowa. Okay. But largely speaking, they're going to be operating through S corporations and LLCs taxed as S corporations. And so, they're thinking probably, okay, corporate income tax doesn't apply to me as much. Income taxes are going from the top rate potentially of 37.5 to 39.6. Is that right? So we got a 2-point move, maybe 210 basis point move, which, is significant, but not earth shattering. There's really, as we look at this, probably a couple of others that really hit you in the tail. And one of them is capital gains taxes. And maybe the other one is payroll taxes too, right? The deductibility of payroll taxes. You want to speak to those a little bit, and I've got a little simple, Rick Ormsby kind of calculating it up on a $30 million sale, $15 million allocated to real estate, $15 million allocated to the business value. We got to make assumptions on what the basis is. But let's say of that $15 million in business value, it's not unheard of. It's pretty normal to see the FF&E allocation being around 40% of the business valuation, and maybe the goodwill allocation being $9 million. So maybe you got a $30 million transaction that has $15 million in real estate, $9 million in goodwill, and $6 million of FF&E. And if you roll through capital gains tax increases from 23.8% to potentially as high as 39.6%, and you guys got to tell me how you feel about all this, I come up with just the old back of the envelope potential tax being anywhere from currently on the federal side, 7 to 8 million, and it could be 11 to 12 million if it goes all the way to the highest, that's been discussed throughout the election process. So that is, guy's got 30 million, got no debt, got no transaction fees, which is always never the case. But if he doesn't, he walks away with 22 million, maybe in one, now, and 2 years from now, maybe he walks away with 18 million or something like this. Pretty big potential difference there, I suppose. What do you guys think? Comments?
Well, in terms of the capital gains taxes, there's something that's really interesting in what Mr. Biden has proposed, and that is this flipping of the capital gains tax could actually be more than ordinary income tax, because he wants to make his preference is to do away with capital gains discount, if you want to call it that, and just make everything ordinary income. But the 3.8% Obamacare tax would still be there, and that would apply, at least the way it's written now, to your capital gains. So you could have potentially a 43.4 capital gains tax. I think, like Dan, it's much more likely that capital gains will go to 27, 28%. It was 28 for some time. Just like we think capital or corporate tax probably won't go to 35. It'll probably go to a flat 28, which is halfway there, which is kind of what he's proposed anyway. So yeah, your taxes there is going to be extremely, it's not certain, but considerably higher. My biggest concern, I think, with that, or maybe we should put that off in terms of talking about the estate tax.
Yeah, we got another slide because I want to spend some time on that. That's something that itching ears will want to hear because it's such a massive issue. What about if you're look, it's one thing to be selling a company, and, I harp on this all the time about valuations and timing and capital gains taxes. People who know me on this webinar hear me say this stuff a lot. But, what about if you're just operating a franchise company and you're thinking about the Social Security tax, number one, how that applies to you if that changes, and also maybe at the local level and the state level, what do you think about property tax increases? These aren't just negligible things. You guys know I'm a Florida resident now. I got out of Dodge, but in Kentucky, man, in the city of Louisville, I wouldn't be surprised to see property taxes increase by 20 or 30%. Because revenue's crumbling as people move away. Comments on any of that stuff?
I see two things with property tax, and I'll let Dan talk today. He's more in tune with that. But one is where capital gains tax is going to affect you generally when you sell your business one time. You're paying these increased property taxes every single year. The next thing that happens is that depresses your EBITDA, which depresses your ultimate sale price. It hits you a couple of ways.
Yeah.
That's the problem with the franchise. You're trying to be where the people are. And, these metropolitan areas know that, right? And so, there's a cost in their theories. There's a cost for you to be in the city of Louisville or the city of Atlanta or, DC or wherever you're at, right? Des Moines, Iowa. There's a cost for being in there. So they want to pick up that revenue. And, look, one of the things we remember from COVID, and, this is not exactly germane to your audience per se, but people are going to work remotely. Okay. So they're going to flock out of these cities. So that's where a little bit of that drain's coming from. And, we experienced the problems in, downtown Louisville. Nobody's going down there. It's a ghost town, right? So they've got to replace that revenue. And, where are people moving? People are moving outside of major population centers. So they've got to build that revenue back up. But the problem is franchise restaurants, the quick casual, I want to be there. I want to be where the people are, right? And that's where the revenue is going to be. So, yeah, they're going to have to replace that revenue. Property tax is an automatic. It's an easy one, right? Mm-hmm. So, expect those things to go up, and it is going to impact the EBITDA, right? You also have the increase in minimum wage and those considerations that are, out there, places that are moving in that direction. Social Security tax, look, we can fix, we have a problem with Social Security, right, Rick?
Yeah.
And how many times have we had this conversation? We can fix Social Security over underfunding real quick. Remove the cap.
Yeah.
Right. So is that going to go up? Potentially, right? Those are sources to raise revenue.
What does that mean to the casual listener here? We can remove the cap. Put that into an example. Let's say a franchisee makes $1 million. Easy math.
So now we're always dealing with reasonable comp, right? In an S corporation, you can't just take 100% of your profits out as S corp distributions, right? So you do have to have some compensation. Somebody typically has some compensation. So normally we try to stay below or at that Social Security cap. Okay, unless we have a retirement plan or something in place that we're trying to maximize a different benefit. So the Social Security cap stops at the 136,000 range, right? If you remove the cap and you have a W-2 of 300,000, okay, which is probably reasonable if you're making $1 million, right? So your exec's making 250, 300,000. Well, you pick up that 6.2% on him up. And the company is going to match that. So you've got this, stealth tax that's going to be 12.4%. And if you do that on executives, right, then boom, we fix Social Security problem really fast, right? But it's at a cost.
A lot of you larger franchisees who are listening, who might have a structure that's like franchisee and partner here, and then maybe, 4 or 5 region coaches and maybe 50 restaurants that have area coaches and restaurant managers. You're talking up here, especially if you got a guy who's making, $150,000, $175,000 a year. Let's say he's making $200,000 with bonus and everything else, and he's managing a significant portion of your business. What Dan's describing could, for that one employee, could potentially mean another $7,000 or $8,000 a year in tax for both you and the company, right? So you multiply that out across multiple folks, and it could be substantial, but even bigger, obviously, for the owner himself or herself.
Absolutely. In Obama, we've had a view of what Biden's done, right? He was he was the number 2 guy for 8 years. Obama brought this topic of the Social Security thing every year that he was in office. So it's something that, if we're predicting what's going to happen, that's probably one that goes away or gets attacked. Let's put it that way. Jim, your thoughts?
One thing that Biden has said is he would like to, and maybe it still stays at 137, but if you make over $400,000 in compensation, there's not going to be a cap above that. In other words, everything that you up to 137 and everything you make above 400 is going to be subject to FICA. And you're going to have that donut hole in the middle. What I expect to happen is, that may happen. There's a lot of people that would vote for that just because, those are the super rich people. But I think also you're going to see more than a creep up, but a pretty substantial increase in the 137 cap that we have now. So, for example, you might have the first 200 is subject to the tax, and then you got the donut hole, and then everything over 400 is subject to the tax. We don't know how that's going to come out, but those are the proposals that have been out there.
Now after hearing all this, I feel like I want to jump off a cliff. Thanks, guys. I really appreciate that. But I got one other piece of bad news. And when I got those dozen phone calls, right, the Monday after Saturday, Biden is declared or self-declared, whatever, as president in waiting. Most of the calls were not as concerned on taxes, believe it or not, as they were on minimum wage increases. And almost all of those dozen calls were large franchisees in the southeastern United States. And it's probably because of the glorious state of Florida passing a graduated minimum wage increase to $15 through 2026. And I heard that over and over again. I mean, and I've personally seen, in our Unbridled business, what the impact of minimum wage increases means to people's P&Ls. I'll say this. If you're in the southern United States, a lot of people are paying an average wage that's $8 or $9 an hour. I think nationally, if you're not in a high minimum wage state, a lot of people are having to compete for labor and paying at least $10 an hour. I don't know what your particular situation is if you're a franchisee. What I can tell you is in 2018, we had a deal in Seattle. And in the middle of the transaction, it went to $15 an hour minimum wage. And I watched, no kidding, over the course of almost overnight, it seemed, maybe it was over 60 to 90 days, but the person's EBITDA dropped 70 to 80%. It was shocking. It was shocking. It was almost like half of the stores went unprofitable immediately. Franchisee ended up in bankruptcy. I mean, it was just shocking. Now, I think the learning from that is a lot of states are going to put in graduated, increases to get to $15. But if, Florida can turn, the other states are probably, in the South are going to be somewhat behind it. And you cannot price your way out of minimum wage increases. I mean, you can't do it immediately. You'll lose your customers. They're not that elastic with their pricing. They're not going to come and order a $3 taco tomorrow if they paid $1.50 for it yesterday. So you have to do it over time and you have to be patient. Those are some of the, learnings I think I've had there. Any comments on that, guys? But that's clearly the biggest one, because I think you're going to find EBITDA on an operating business, is especially one that operates, with relatively low wage employees. It's going to be hit pretty hard. And there's been a lot of rhetoric at the presidential campaign level about $15 minimum wage being a living wage.
Well, the difficulty with all that rhetoric is that even if that doesn't happen, it immediately affects the value of your business, just because banks are going to be a little bit more reticent to lend, not knowing what the future is going to hold, not knowing whether that borrower is going to be able to fund that loan over time if the government takes 80%, 70% of the profits away. So I think it's going to affect people's businesses regardless of how it actually comes out in terms of pricing the sale.
As always, if you're a franchisee, you want to be operating the best brands and be the best operator. And if you do those things, you're going to be fine. Because I've always believed that a cream always rises to the top. You know what I mean? Like the best always gets better, and the ones that struggle are the ones that were marginal to begin with. So if you're operating a brand that's a legacy brand that hasn't performed well historically, or is kind of languished along, those are the brands I'd tell you, need to be cognizant of operating into 2022 and 3. Let's talk a little bit about, about PPP and loan forgiveness. It's a little bit, it's maybe a little bit apart from, it involves taxation. You guys have done a lot of good work related to this. We've got a lot of new news coming out. Could you kind of give us a little update on what you think just kind of what's going on, how to prepare for paying for a possible tax in 2021, how to think about all this stuff?
I love your screen. You've got it laid out there. The first question and the most looming question is the triple P going to be taxable, right? Right now, as the code stands, as Munchin and the IRS have said, hey, it's taxable. And it's taxable whenever year you get it forgiven. Now, you're probably not going to get it forgiven in 2020, last part of this year, because nobody's accepting applications, really. None of the big banks are accepting applications. Under 50,000, they're taking those applications, and then everybody else is pretty much stalled. Okay. So you're going to get your forgiven notice. That's going to happen in 2021, but that's going to revert back to your 2020 tax return. Okay. And remember, the conversation is, the loan itself is not taxable. The forgiveness of the loan itself is not taxable income. Okay. That's what they've said. But where they come back and make it taxable is those expenses that gave rise to the forgiveness. Those expenses are not deductible, right? I love how tax, we start getting in all these conversations, accountants and CPAs and lawyers, right? And we really, the loan's not taxable, but the expenses that gave rise to it are not deductible.
I mean, that's confusing. That means, why don't you just make it easier? If I borrowed $100, I got to pay 35 of it back. You know what I mean?
That's exactly
make it understandable,
We double talk all the time. I mean, it's taxable income.
Yeah.
So what do you do with that right now? Okay. You have to prepare your tax projections under 2 scenarios, I think. The current scenario is it's taxable. You have to recognize that fact. Okay. There's the potential, and we're hoping the lame duck fixes this, and everything that I've seen on the proposed laws are they do fix this. Okay. They just can't come together right now because they're playing partisan politics right now. Okay. If we can get that, that would be the best Christmas present for a lot of clients, right? Because I got this relief loan and now I'm going to have to pay tax on it. And if it's, $2 to $5 million, that's a big number that I'm paying 35, 37% on. Yeah. That really didn't help me. I appreciated it, but it really didn't help me in the long term. Okay.
So I made a $3 million loan. I got a $3 million loan. It's basically all forgivable. I'm sitting here and right now I got $1 million I got to pay back under the current legislation. When do I have to pay this darn money back? Does it go against my 2020 tax return, but I pay it in 2021?
Well, so that's an interesting point. So we always want to be, subject to safe harbor, right? So we want to pay our tax based on the prior year or 90% of the current year. Okay. So we're looking at, clients right now under those scenarios, and we got to run both scenarios. And then we have to flip a coin. If we've got you to prior year safe harbor, right, then you're good. But who wanted to pay prior year safe harbor in March? When I was calling you and saying, hey, you got a first quarter estimate and it's a large one, and you're going, I don't know if my doors are going to stay open. What are you talking about? I got to write a check, right? Yeah. And that was the beauty of Triple P. It came out and said, hey, this is going to be non-taxable money for you, right? And everybody said, hooray, that makes a lot of sense, right? And that, I think, really helped the recovery, right? Because we come in there, we flood the market with dollars, and the stock market takes off, People get calm, it settled things. And then, they come along and tell us, well, we were just kidding about the taxable part, right? So you got a first quarter that you're underwater. Then what happened for your second and third quarter? I mean, we were all waiting for the surge again, right? So nobody's wanting to release extra capital, and let alone we don't want to give it to the government, right? So a lot of people are coming into the end of the year and they're not on the prior year safe harbor, right? And like you said on the quick serve, they picked back up, right? They're making a little bit more, and you're not, I'm definitely not telling my staff people, hey, we're doing really well, because I'm beating the drum, man. This is hard economy. It's a hard economy, right? But you're dropping dollars to the bottom line, but you don't know. I mean, yes, we have a vaccine. Who knows? But the question, to your point, though, Rick, is, January 15th, you want to make your fourth quarter estimate and get yourself caught up, okay, as much as you possibly can. And then the question is that airball taxable? Look, all taxes are paid and due. If you're a corporation, it's March 15th. If you're an individual, it's April 15th. So you're going to have a payment event that's going to happen there. Jim and I debate whether or not we can get a reasonable cause waiver on an estimated tax penalty. Maybe you can, maybe you can't. The law says you should be paying it, right? Mm-hmm. But we are in a pandemic, right? I don't know.
Interesting point. It's an interesting point. It's an interesting point.
So that's the question. April 15th, for most of your S Corp folks, are going to have to pay a tax. And then, heaven forbid, if we're going to safe harbor, you're paying 1/4 of 2020's taxes, right? Mm-hmm. Isn't that a scary thing, to get to the safe harbor, right? Mm-hmm. So, I mean, that's a big issue. So you've got to think about that. We hope they fix it. We're doing strategies that leave people pretty open. And I'll be honest with you, if I have to pay the estimated tax penalty, I'll pay the estimated tax penalty rather than release the dollars. But when I say that, I have to tell the client, hey, are you willing to pay that 7% estimated tax penalty that's non-deductible? And, they want to quantify it. And, I've got a $5.5 million Triple P loan right now. Without the loan, it's $1.8 million loss. With the loan, it's, $3.5 million income, right? And what's the estimated tax penalty? I mean, that's what they wanted to know, because we're trying to give as much time, for liquidity purposes, because they need that money. They're not ready to write that check to uncle.
Yeah. I'm hopeful that legislation gets fixed. And again, I made the comment today. I saw a point that they're talking about being able to issue a second round for 300 employees or less. If you had any quarter in 2020, your revenue was down 30% or more over last year, you could apply for a second round of money that could be fully forgiven. So that may apply to second quarter, especially for a lot of our casual dining, fast casual clients or gym clients, you know what I mean? People who operate health and fitness businesses and auto businesses because their revenues were down a lot doesn't probably apply so much to the QSR franchisees. Keep note of that. Guys, we've got 11 minutes left. And so I wanted to make sure we hit the rest of this. So Jim, you're on deck, buddy boy. What do you think about estate planning? This is something that really needs a little bit of attention, if you don't mind.
I think estate planning changes are low-hanging fruit for Democrats in that because it affects only the filthy rich, right, as they see it. So the proposal has been to go from the current exemption, I think it's $11,580 per person, basically $23 million per couple, to $3.5 million per person, and to decouple the gift tax from that and limit gift taxes during your lifetime to $1 million. The really, really scary thing they want to raise the tax rate to maybe 45%, from 40 to 45, which is not that big a deal. But reducing the exemption affects a lot of small business owners. But to me, the really scary part is what he's proposed with, the step up in basis when you die, whatever your assets are worth. That's what your heirs take as a tax basis. They can immediately sell that. The capital gain is just gone. It dies with you. He's talking about doing away with that, number one. But worse than that, he's talking about making death a gain recognition event, which means when you die, not only do you have the estate tax, you have potentially a 43.4% income tax, which comes off first. And then whatever you've got, whatever they leave you after that is subject to the 45% estate tax. So you're talking about, we've run the numbers, and the government basically could get 68% of what you've worked your whole life for, assuming you have no tax basis. And you know how it is with most of these closely held S corps, tax basis is not that huge. So assuming a $10 million business, for example, the government could get 6.8 million of that, leaving your heirs 3.2%, just under a third of what you've worked your whole life for.
And the bill is due immediately within 9 months after death too. So what you're doing is you're putting a gun to the heads of your kids and saying the repercussions are dramatic of what happens next. I mean, they're dramatic. Yeah, I don't have a family with any money, but if I did, and all of a sudden the $10 million gain comes to me and I got to pay $6.8 million in taxes that I don't have, that forces me to liquidate. And then when I liquidate, you talked about this earlier, I have to liquidate at a discount, don't I? Because I'm in a fire sale, daggone it. I got to get the darn money to pay the tax. So whatever that I get a hold of that's worth $10 million, unless it's stocks that I can trade quickly, I got to dump it for a discount. It's a fire sale to pay the taxes. It's almost criminal. I don't know.
Well, and you could be selling into a down market too. But hey, there is
that's true.
There. We do have Section 6166 for a closely held business to allow you to pay that tax over time. But the best your kids are going to get is the 3.2 million of your estate. If you have to sell it quicker than you should because the market's not right, then they're going to lose more than that because you'll sell it for less than its value at date of death.
Planning's critical. A lot of your clients I know are putting things in trusts now to cover their assets and plan for their legacy to avoid a possibility this exemption will go lower, way lower. What about insurance?
But one thing on that, there is no clawback. For example, if you give $11 million to a trust today, and then the law changes and reduces the exemption to $3.5 million, that $11 million is out. They're not clawing that back. Okay, so if you're concerned about the exemption for estate tax going down dramatically next year, it's a good idea. It's kind of late, but it's a good idea to make those gifts today if you can, or before the 31st.
Yeah, well said. Insurance becomes important too, right?
Insurance is a huge thing. We're starting those conversations again, putting in an irrevocable life insurance, looking at second to die policies. If it's taxable at the first death, the second to die is not, you need to have a first to die policy. Are you insurable? What are you doing with those? Making sure that you've got a reputable insurance company. I just had the conversation earlier this week on a, $5 million policy. You've got to have some liquidity. And that's what life insurance is for. I mean, that's really what it comes into the high net worth person is as a vehicle to help pay the estate tax, a vehicle to make sure that you keep some amount of net worth in your family. So you definitely have to consider it.
Isn't it just funny? Here I am sitting here. I just started rubbing two nickels together, selling chicken stores and taco stores and pizza stores. Simple, right? Make a phone call, get to know people. Why does this get so complicated, man? I mean, you know what I mean? I'm just listening to you guys. I'm like, oh my goodness, it hurts my brain. But thankfully, you guys, we'll lead into the next slide, right? Because it hurts my brain, and you guys are good advisors. And so I do quarterly tax and legal planning meetings with these two gentlemen. I mean, you should too. It isn't, you know what I mean? You just got to trust good professionals. And these two guys particularly are really good with creative ideas. And so I don't know if you have anything that you wanted to share, but you got to think about revenue recognition, expense planning, borrowing against related companies. If you're trying to hedge yourself against tax increases in 2021, look at distributions, extended filings. We just got 3 or 4 minutes. I know there's a lot we could say about this slide, but let me do a little rapid fire Q&A. What do you think these guys, gentlemen, what do you think changes on the tax and legislative horizon? Which ones are most and least likely to occur, do you think?
I think the most likely to occur is some change in the estate planning exemptions. Maybe not as dramatic as he wants, but that's kind of an easy one for Congress to get together on, right?
Yeah.
Rick, we do have a question, S Corp versus C Corp. Do the potential income and estate tax tips the balance one way or the other? Yes, they do. So C Corp was in play for a little bit. C Corp's not so much in play right now. It depends on what the tax rate. If we go back up to 28%, you've got to run the numbers. You've got to look at it. One thing that we didn't mention, and since we're in rapid fire, we're going to lose the SALT. I mean, with the SALT's $10,000, state and local income tax deduction. You're going to lose that. That's one of the things Biden wants to do. He wants to means test that again. So it's almost an alternative minimum tax. So you'll get, 28% tax benefit of your itemized deductions, but he wants to keep the SALT.
Dan, sorry to interrupt you. That's a big deal. So as simple as an old redneck could take it is this: if you're a charitable person and you're going to give away, $100,000, I don't know, stupid number, right? $100,000 to your church, and you're expecting at your tax bracket to get a 40% kind of deduction. Yep. What Biden is proposing is that deduction only becomes 28% now.
That's right.
That sucks.
Well,
that sucks for charities. That sucks for charities.
Well,
it really does.
So if we go back to your slide, and you don't have to go back, but in your last slide, it's you do need to have a conversation with good trusted professionals. You need to be crunching the numbers. You need to be looking at this prospectively of what's going on and what's your end game. My end game for my clients is to keep as much money as we can, right? To find the strategy that makes sense. And if you have to put in an S corporation or a C corporation, or you do a conversion, you do those things when it makes sense, but you've got to run the numbers, and you have to have those dialogues back and forth.
Yeah, it's great. Well said. We got time for one more of these. I'll take a couple of questions here. I had one question come in, but I'll address the third one here is how will these tax changes affect valuations? I mean, who knows? We're coming into a tough winter before we have the vaccine rolled out. It's possible that we see consumer spending kind of dip. I don't know. Maybe we get this big government stimulus and consumer spending comes back. I think when the vaccine comes out next summer, my opinion is you're going to see people out there spending money and probably spending it pretty forcefully. So you could see in your business, your EBITDA going up potentially, but I think also the valuation, the multiples, the EBITDA multiples and cap rates are going to get impaired as you have, number one, more supply on the market, which is going to happen in the first and second quarter of 2021. Because like I said, you're not real bright if you're thinking of selling in the next 3 years and you don't consider it now or soon. I'll say it again, you're not real bright if you're doing that. So that's going to cause a lot of clients and a lot of franchisees to consider selling. Supply is going to increase. Demand stays the same. Price, what happens? It goes down. The other thing is, I think the tax regulations and the minimum wage impact is going to start creeping its way into the EBITDA multiple. So in other words, someone might say, gee, I won't pay 6 times EBITDA or 6.5 or 7 times EBITDA for this business in Florida anymore, knowing that in 6 years, I've got to pay $15 minimum wage. I might now reduce my EBITDA multiple to 5.5 or 6. You see, so these little things start filtering their way through the marketplace. And I think what you might see is you might potentially see EBITDA lifting, but EBITDA multiples and cap rates getting worse. And the net effect could be that valuations probably, stay close to where they are now. That might be just a guess. But then you've got higher taxes that you have to think about. So The net is that I think we're running into an environment here where if you're looking to maximize the net proceeds in the sale of your company, I think the valuation, the discussion here leads you to a negative place beyond the middle of next year is just kind of my commentary. I want to thank everyone for their time today. Here's the Dan and Jim's contact information. I'm sure any of the three of us would be honored to answer any of your questions at any time. Any of them, really. And we're delighted that you're on the call. Check out the webinar. Watch for the email to come with a review of this, replay of this webinar, and also the podcast. Guys, do you have any final words that you want to share with folks listening here as they hang up here?
Well, thanks everybody for your time. Hopefully you have good advisors. You need to use them. Put the topics on the table. This is the time to be proactive. The next couple of years, you want to be ahead, not playing from behind.
That's great. Well said. Okay, guys, many best wishes. Hey, guys, everybody, Jim, Dan, and everyone listening, Merry Christmas, man. Absolutely. You know what I mean? Let's persevere. It hurts, doesn't it? And you know what? There's a lot of psychological pain and people are fatigued. We're sitting in our darn houses. Kids are not in school. We can't see our loved ones when they're sick and passing away. I mean, it isn't the easiest, but daggone it, we're resilient people. We have been for 200 and some odd years. We're going to get through it. Keep a positive attitude, man. And Merry Christmas to both of you.
Absolutely. Merry Christmas, everybody.
See y'all later.
Thanks so much for entering the Boiler Room today. You can find our podcasts on iTunes, Google Play, Stitcher, TuneIn, and Spotify. If you like these podcasts, please listen, rate, and review. I also encourage you to visit our website at www.unbridledcapital.com for the best franchise M&A and financial resources in the industry. Our website includes webinars, podcasts, videos, white papers, and a list of our past M&A transactions. Please note that neither Rick Ormsby nor Unbridled Capital Advisors LLC give legal, financial, or tax advice. These podcasts represent opinions that have been prepared for informational purposes only. We expressly disclaim any and all liabilities that may be based on such information, errors therein, or omissions therefrom.